Okay, so the title of this session is Engineering the Exit. And I'm going to give a disclaimer that this is my story. And like all the attorneys on TV say, past performance does not guarantee future results. So this is what worked for us. And I was thinking about, how I wanted to kick this off. And it wasn't really about engineering the exit because that, obviously was kind of the end goal that we always had in mind. But it's really about what we were focused on all along building a sustainable company, solving important problems for an underserved market, delivering meaningful value to our customers, not focused on vanity metrics, not focused on all the things that Andrew just talked about. And as someone who's in the founder seat, I got to give kudos to Andrew because that talk is everything that founders should listen to. Everybody just gets so turned upside down on all of those things that a friend of mine calls splashing water, right? You're just splashing water. Look how busy I am, but all you're doing is just getting yourself wet. You're really not making any progress. So, and we were always striving towards the right metrics, acquiring customers, generating revenue, keeping those customers, and keeping them satisfied. And we took care of our employees, who are ultimately the ones that were building a sustainable company. So you see that flywheel starts. So, as I was thinking about how I wanted to break down this presentation and hopefully keep it clear, concise, and interesting, and I will be the first to admit I know that I'm the only thing standing in front of all of you and our networking happy hour as we're sitting in a windowless room in a hotel. So, I decided to go with the theatrical breakdown of this presentation of Act 1, Act 2, and Act 3. So, what was the inception of the idea for Verivend? Where did it come from? How did we start and continue to build traction? And how did we find those strategic partnerships that ultimately led to our acquisition? And then we'll leave it open for Q&A. And if nobody wants to ask any questions or hear me talk anymore, we can just say, we'll talk about it at the happy hour. So who am I? I don't really fit the mold of a startup founder. I'm from a town called Grand Island in New York, which you can see is pretty equidistant between Buffalo and Niagara Falls. Proud graduate of Grand Island High School, and I went to Canisius College. So, those are kind of like two strikes against the typical founder DNA that, I'm not from New York City, I'm not from the Bay Area or Silicon Valley, I didn't go to an Ivy League school, but I'm just really damn stubborn. And my wife will be one of the first people to tell you that, where once I have an idea and once I have a vision, I just keep trying to run through that brick wall. So, got my bachelor's degree in computer science and then my master's degree both at Canisius. I will skip over the part where I wanted to be an emergency room trauma surgeon and my winding road through my undergraduate degree, but have always fell in love with technology, and that's why I pursued the computer science degree, and then ultimately didn't know what the heck I wanted to do with my life after that, so I just stayed on to live out that college lifestyle for a few more years in my master's degree. So I've really only worked for three companies in my entire career, but all of them fit a similar mold. So the first out of my graduate school was a company in Buffalo called Liquid Matrix. It was a startup that got acquired by a company called DataTel out of Fairfax, Virginia. Second one was an insurtech platform, Liaison. A lot of people know that. They were acquired by Towers Watson, which ultimately became Willis Towers Watson a few years ago. And then, of course, we're talking about our fintech company, Verivend, that got acquired by IALTA earlier this year. So thinking back, I was like, well, what does higher ed tech, insurtech, and fintech like have to do with each other? They're really, not like anything related, right? Well, looking back, all of these companies were focused on industries that were just weighed down by outdated systems, manual workflows, and layers of unnecessary friction. So you look at, previously, how did applicants apply to colleges? Just like in the screenshot, filled out a paper application, mailed it in, and then you wait for the big folder in the mail. Hopefully that says you're accepted, or you wait for the decline letter. Same thing with insurance. How do employees purchase their employer-sponsored health plans? They fill out a form and they give it to the HR person. And then with fintech, a lot of checks and a lot of wires. So not only were these companies solving a problem, but they were redefining the way for how these industries operate. Okay, so Act 1, inception. Where did the idea of Verivend come from? So this, quite literally, is how Verivend started. This is a picture that we took in my kids' playroom in the basement of my house with the first Post-it notes of what we thought that we wanted Verivend to be. So I know that's kind of hard to read, so I zoomed in on a couple just to show you the makings of that original inception of the idea. So controllers, CFOs, finance. We were a fintech company, so we were starting to target who was our main buyer persona, who are the people who actually cared about finances and transactions and money in companies. The second was, what was our onboarding workflow? In previous companies, I managed and built and scaled implementation teams where it was Excel requirements and workbooks and months of labor and blood, sweat, and tears. And by the time the customer actually got their hands on the software, they didn't even want to look at you or hear your name again. So I said, no more of that. We want the time to value for our customers who are signing up to use Verivend to be as instantaneous as possible. So that was our onboarding workflow. And then lastly, what did we want Verivend to do? Send invoices, pay invoices, connect to other buyers. The original inception for Verivend was to transform accounts receivable and accounts payable because my co-founders and I saw this in previous companies that we worked with. It was Oracle, it was NetSuite, it was checks, it was wires, it was trips to the bank, it was manual reconciliation of transactions, and there was no modernization for AP and AR. So I had to dig deep into the Verivend archives. And another fatal flaw of mine is I don't throw anything away. And my wife will be the first to tell you that as well. I save it all. So you can see in the lower left-hand corner, before Verivend was Verivend, we were formed as Payment Co. Inc., just because we knew we were focused on payments, but that was the only name that we could come up with, and it was very uncreative. So even looking back, you can start to see some things transform and those common ideas thread through the history of Verivend. So antiquated processes consisting of paper checks, wire transfers, the process for automated and streamlined payment processing difficult to achieve for businesses. And then again, how does Payment Co work? Well, there was a seller, there was a buyer, and there were financial transactions in the middle. And how did we have, what do we have to do to focus on making those more modern and efficient and secure? So, Act Two, traction. We launched in May of 20, right at the height of COVID, which was actually an advantage to us because nobody was going to work, nobody was in the office, nobody was able to be there physically to accept payments and go to the bank and deposit checks and all the manual workflows that they needed. So, from May of 20 to September of 21, did we have product market fit? We were focusing on everything from small to medium-sized businesses, waste management companies, manufacturing, trucking and transportation. We even had some organic expansion into law firms and doctors' offices and medical practices. And we thought, yeah, this is great. All of these types of industries have that common thread of being challenged with AR and AP. And we had some really good traction, but as you can see, it was spread really, really thin. And we weren't focusing on any one industry to really help transform it. So what we did in October of 21, we raised our first funding round. And at that point, we created our own aha moment. What I mean by that is that was driven by me not having any time or money to focus on how we were actually going to take in the capital. So as good of our, as our attorneys were writing the docs, getting subscription agreements signed, I wasn't going to spend the time to do this manually myself to take in the funds. And I wasn't going to pay my law firm to do this. I don't even care if you're, paying a paralegal or an associate to do this. It's still hundreds of dollars an hour. And, I'm not going to have them take the funds that we were raising into their escrow account or their trust account. So I said, well, wait a second. I have a platform. It's moving money. It's helping businesses process their payables and receivables. That's not all too different than raising funds. So what we did was we put private capital in the mix. So the thing that would have made sense was at that point, just go in and focus on private capital. But we just added it to our, what I call our market product fit. So at that point, and this was really painful, we were just looking for a market to apply our payment solution to, and we really weren't focusing on it. So we had a lot of conversations with our board of advisors, our board members internally, and there was just a lot of strain on what was going to be the best fit for Verivend. And David, I don't know if you remember this call, but I do. We talked to David Brown, and he said, private capital payments, and I quote you, you said, is an unaddressed, unanswered industry, and nobody's doing it, and maybe you should look there. So that's exactly what we did. So what we also noticed in just the first quarter of 2022, something really interesting start to happen. Only 20% of our total customers at that point were focused in private capital, private equity firms, independent sponsors, VC syndicates. But 80% of the revenue was coming from that 20% of customers. So your real quintessential 80/20 law. So we looked at the data and we said, okay, we think that there's something here. We think we're on to something that we weren't before. So what we finally did was we cut off everything else. And this was a really hard decision because we had customers in each one of these industries that loved the product, that were gaining value from the product. We even had customers say, "You've cut my cash flow time down significantly, and we can operate much more, easily because we have more cash in the bank, and we can, focus on our receivables even more." And we said, "Sorry, if you're not in the private markets and you're not raising or deploying capital, you're not a fit. So we have to part ways." And, as a founder, this is one of the hardest decisions to make, but it was almost, one of the clearest because, in my opinion, the best way to find out what you need to be doing is to not know what the hell you're doing. And we didn't know what the hell we were doing at this point. So we focused in on private capital. And this is just an example of, one of our board decks when we decided to make this change and make this focus from a BDO private capital pulse survey where almost half of fund managers at this point, back in the fall of 21, were trying to get deals done faster. And how can they get deals done faster? They can use a platform to transform that process. So what we did was we refocused and we said, okay, what the heck is Verivend? What are we doing? So we're a SaaS platform that makes the movement of money three things: efficient, frictionless, and secure. So then we applied that to the private markets. And we said, we're Venmo for private capital. And a side story, I actually hated this at first because I felt like if, as a founder, you needed to say we're the this of that, we're the, Uber of whatever, or the Venmo of this, that you really didn't have a purpose. But this really helped us lock in because once we said this, it did two things for us, talking to customers and the market. People either said, wow, that's really interesting and I get it, or what are you talking about that makes no sense? And they challenged us on it, but it opened up a conversation for us with them. So playing back what Verivend was, we said we're going to make it efficient for GPs and sponsors because they waste a ton of time running deals and running funds and raising capital and doing a whole bunch of things that takes their focus away from what they should be doing, which I'll get into in a second. We want to make it frictionless to invest for LPs, right? If you're an LP or an investor and you have two options to invest, one that's paper-based and you have to send wires and go to the bank and worry about, did your funds go to the right bank account? Or you have one that you can quite literally do it on your phone from wherever and whenever you are. Which one do you think your LPs are going to choose? And then just greater security for everyone, because the way that things have been working cannot be the way that things work in the future, to Andrew's point. So GP and investment sponsor priorities, I say this all the time, really should just be focusing on three main things: finding deals, closing deals, generating returns. Anybody who's run deals or run funds disagree? You want to focus on anything else? Paperwork, sending out DocuSigns, reconciling wires? I didn't think so. But something interesting happens when you start that. All of these things take your focus away from those three core principles. You've got to market your offerings, you've got to onboard your investors, do KYC, AML, manage a data room, give investor updates, manage commitments and who's in and who's out, get those subscription agreements signed through, some sort of digital signature utility, reconcile very opaque wire transactions. I mean, we hear it all the time. Somebody's trying to close and you've got six investors that are all investing 100K and you get 100, six wires for 100K in one day. Whose is whose? And then when it comes time to do an exit or liquidity event, manage getting all of your LP bank account, usually through email and on a spreadsheet, which is just insane because it's 2025, and then sending out those distribution payments. And then this is what the typical workflow looks like for investors who are investing into a deal or a syndicate or a fund. They get an email message. They have to download the PDF for their capital call notice. The third one is a picture of a stove, in case that wasn't clear. They put it on the back burner. There's a phone call from the GP. It aggravates the LP. Then they finally download it. They look at it. They're aggravated again because then they need to print it out, go to the bank or log into their banking portal, have the bank send the wire, all at the end of it to be susceptible to a phishing scheme. Wire fraud has continued to increase, and the private capital markets have been a growing target for fraudsters just because of the large dollar volume of transactions happening, right? If I'm a cyber criminal, do I want to target people who are moving hundreds of thousands or millions of dollars, or do I want to target people who are moving 10 or 20 bucks? So, and again, if it's easy for investors to invest, they're going to invest more, assuming that, returns and all things are equal. So this was a PR newswire that said scammers are targeting Wall Street in new capital fraud schemes. So again, just the growing target on the private capital industry. Now, I intentionally redacted the amount there because I wanted to try to keep this interactive. Amount of dollars. What do you think is the average dollar amount that's defrauded from investors every single time there's a fraudulent capital call notice or wire instructions introduced into the mix? How much? Keep going. I heard 50K, way more. 5 million? I appreciate your enthusiasm, but a little bit lower. A little bit lower than 2 million. We're getting close. $809,000, almost $1 million. So I say this to our customers in the market all the time. Do you really want to put your investors and your LPs that you've worked so hard to develop that trust and that relationship with at risk of something like this? All right, next pop quiz. Which one of these capital call notices is fraudulent? You got a 50-50 shot, left or right? Left? They're both fake. I fooled you all. But again, that just goes to show you that it's really hard to pick out fake capital call notices. I get them all the time. I get fake distribution notices in my email, and you have to just watch them like a hawk. And again, when you're a GP or an investment sponsor and you're at that finish line of rushing to close a deal, the last thing you want is to put your LPs at risk of wiring their money to the wrong place and never seeing it again. So we started with what I like to call our payments wedge, capital calls, distributions. That was great. And this was in late 21, early 22. But an interesting thing was happening if we think back to what was happening in the market at that point. We're kind of getting out of COVID. People were returning to work. And what was also happening was the economy was changing for the worse, not the better, unfortunately. So as we continued to push into the private markets, we got a lot of feedback from prospects that said, it's a different world now. I don't know when I'm going to be raising capital, if I'm going to be raising capital, if we're going to have a liquidity event. So come back to me in 3 months, 6 months, 9 months. And we were like, geez, the timing is really, really bad right now. So what we did was we thought, how can we do two things? Number one, listen to our customers, meet them where the needs were. But then two, how do we get out of this timing crunch that we're in? Because we can't just have this huge backlog of prospective customers in Salesforce and hope that they're going to raise capital again. So two things happened. We were getting a lot of great feedback from our customers of saying, you know what, being able to fundraise, call capital, do distributions on your platform is great, but there's a lot of other pieces to that puzzle that we want to do in the same place. We don't want to have to manage a huge tech stack of solutions. We don't want our LPs to have to go to a whole bunch of different places because it's an unmanageable process. And what we like to say is there's 1,000 points of light in the private markets, and it's just a very fractured and fragmented landscape. So we said, okay, well, let's listen to our customers. We're always big on our customer-driven roadmap. So we started building all of the other tools and utilities that they can utilize to really round out the deal management or the fund management process. And then that also helped with the timing, because if our customers and our prospective customers weren't ready to raise capital or do a distribution payment at that time, there were so many other things that they could do, from reporting their track record from previous deals to attract and build relationships with their LPs, to marketing and fundraising new deals, all the way through investor onboarding, data rooms, and every other touch point. So from our payments wedge to our enterprise platform is how Verivend grew with our customers and in the market. So today, what it looks like, just to give you a little preview, is a GP mission and control and end-to-end transparency. This is an actual screenshot of Verivend so that GPs and fund managers have everything at their fingertips. I was actually just talking to a friend who runs a real estate investment firm. I'm not going to mention who, because it was a really eye-opening story. He said, we did a capital raise about 6 months ago, and we thought one of our investors funded his $500,000 commitment. And 6 months later, we realized that the funds never came in. And now this investor, because time is a killer of all deals, isn't going to invest. So I said, well, what is Verivend worth to you? It's worth $500,000, in my opinion, right? To be able to have that assurance that that $500,000 investment commitment came in is worth that much. And we allow our customers to spend more time on their deal flow and managing deals and less work managing them. So this is an opportunity for our customers to digitize their entire investment memo, get in front of their potential and current LPs, get them engaged and get them interactive. It's not just a deck or a PDF or a static PowerPoint anymore. It's a living, breathing site where you can gauge activity and interest from all of your LPs. Institutional grade data rooms, investor relations, being able to share documents, post updates, correspond in real time with secure messaging with your LPs, investor onboarding and commitment management, quite literally being able to get all of your indications of interest, finalize them, round out your cap stack, and close your fundraise in a much shorter amount of time than you would normally. And digitize signatures and subscription management, because subdocs are always part of the process, and being able to do those in a fluid manner with your LPs right in the same place that you're doing everything else. And this is the real differentiator. This is what we're doing that nobody else is. And I get this question all the time. How are you different from any number of platforms? And I'm not one to do the negative political ads and, throw shade at what other people are doing or not doing. I like to talk about what we're doing and what we're doing better than anybody and what we're doing different than anybody. We're the only purpose-built payments infrastructure for the private markets. So we are quite literally processing transactions for LPs, for GPs, securing them, making them more efficient and more frictionless. So before I get to Act 3 of acquisition, because of all this, because of this focus, because of really honing our focus in the private markets, we're now trusted by over 200 investment sponsors and GP customers across the country. They've run over 1,000 investment vehicles on our platform with over 25,000 of their investors, and we've processed over $2 billion of transactions. And we do an annual survey with all the LPs and investors that use the platform with our customers every single year, because we really think that in a customer, there are always two customers. There's the GP and the sponsor, and there's the LP and the investor. Because if the LPs and the investors are having a terrible time with Verivend, then that's just going to go right up to the surface, and our customers are going to have a terrible time, and it's going to be a bad day for us. So we are proud to have earned a Net Promoter Score of 72, which is well into the excellent category. And we continue to refine this because we want all experiences with Verivend to be as best as they possibly can with both GPs and LPs. Act 3, acquisition. So this is the email that kicked it all off. And sometimes it's just one connection or one email that makes all the difference. But it wasn't just one email. So this is an email that Rick Cashel, who's the managing partner and founder of a VC firm called FinTop Capital, sent me on February 14th. Talk about love for a founder, right? I look back on that and I was like, wow, that's pretty cool. So, Rick and I and FinTop had developed a relationship over the previous 18 to 24 months. And as we focused in private capital, it was really easy for me because I was, working to extract cash out of the same persona, right? Whether it was an investor who could use the platform or a customer who could be an investor, it was all the same persona. And we had exactly that just happen. And even to this day, where our early investors became customers and our customers then eventually became investors. So I was always chasing Rick and FinTop. You should be a customer, do you want to invest? And it ultimately led to this email. You should meet Scott Ganellis. So I said, never heard of the guy, but I'll give it a shot. So a couple weeks later, went to New York, and that's when I got introduced face-to-face with Scott Ganellis, who's the co-founder and CEO of IALTA, Bill Sherman, who's the co-founder and president, LT, who's the co-founder of IALTA, and also the founder and managing partner of a private equity growth stage firm called Westcap, and Jamie Hildreth, who's their partner and head of asset management. So, from the founder perspective, at this point, my co-founder and I were like, we don't really need this, and we don't know if we really want it. It was kind of a very questionable proposal of them saying, we want to bring you into the IALTA family, because we felt like there was just so much more of the Verivend story to be written that we wanted to work on. But there were three big things that made us say yes to this. So one was the shared vision by that team. Two was their industry track record. And three, which was really cool, their upstate connections. So introducing the IALTA solution, and this is going to sound really similar to what I just said that Verivend was focused on. Having a transaction-ready investor portal, giving GPs their mission control, no longer having to operate in the dark and manage their funds and their syndicates through paper and fragmented systems. And then third, centralized data, operating at that transaction layer where nobody else was. Because just by GPs and LPs using our platform, it was creating that source of truth, that data set, which historically has just been on fragmented PDFs and static documents. And IALTA looked at these three things as the building blocks of a comprehensive fund management system, the same way we thought about it. Second, incredible track record in the industry. Hopefully some of these logos are recognizable. But Scott and Bill came from a company called iPrio that was incubated out of Blackstone. And Merrill and Rick formerly ran iLevel that was acquired by iPrio. So these people knew what they were doing. And we felt like being able to be part of what their vision was and having our vision be part of what they wanted to do was something that could be, really, really impactful. And then three, which was one of the coolest things, Scott's family is originally from Boston, New York, just south of Buffalo, and Bill is a graduate of the University of Buffalo. So we felt secure in our ability to continue growing in upstate New York. And this was quite honestly the reverse of an acquisition or an exit, because I've been through it the other way where big company likes to scoop up little company, doesn't really understand what they want to do with it, and ultimately it just winds it down. So with us being able to be part of the IALTA vision, it was really just an acceleration and a catalyzation of what we were already doing. So that's the story of how we went from a wall of Post-it notes to me being up on stage here today. Like I said, I'm happy to answer any questions on why we did what we did, how it happened, how we're continuing to serve the private markets, because all of you are potential customers, most likely. And I see one hand up, and yeah, we take the first question.
What'd you get your buddy for Valentine's Day?
What did I get my buddy for Valentine's Day? I sent Rick a nice thank you and called him out in my my post-acquisition LinkedIn post. Yes.
You've been acquired by IALTA, but it sounds like you've got continued involvement. Tell us what that involvement looks like. I know it's fairly fresh, but what does that involvement going to look like a year from now, 3 years from now?
Yeah, thanks, David. So yeah, that was another one of the big attractive factors of being able to start this next journey of Verivend with IALTA. So my co-founder and I are now on the executive committee along with Bill and Scott and a lot of other talented people. And we really just saw this as the next chapter of that growth and be able to continue doing what we were already doing. And they're builders. They're not, let's acquire a company, break it all apart, put our fingerprints all over it, and do something else with it. So we're still committed to Buffalo. We've increased our workforce there. We've got our office in Manhattan. We've got other remote employees. And prior to acquisition, we were about 12 people in Buffalo. Now we're a team of about 35 right now, split between our two main offices and remotely. So yeah, it's just the ability to continue that vision and share that vision with IALTA, and through many thoughtful conversations with them during the getting to know us stage, we really saw a lot of us in them, and I think they saw a lot of them in us. Any other questions?
Your company was founded in Buffalo, correct?
Yes.
Did you ever consider moving?
No.
Why not?
I agree with everything you said on these incentive programs and these relocation programs. I don't really think they work. If you look at a lot of them, I mean, there's ones in Buffalo too. Those, I mean, nothing against them, but those founders that are asked to move there really just kind of check the box. They have a vacant office there. They don't really set up shop. And after that time expiration is over, they're back to Austin or Silicon Valley or New York. Let me take my immediate no back and say, yeah, kind of. One of our investors, as I was pitching them, they were from Band of Angels out in Silicon Valley. They said, Rodney, do you feel like you're missing an opportunity by not living in Silicon Valley? And I took a second, maybe a little bit more than a second, to think about that. And I said yes and no. I said yes, because sure, Silicon Valley is the epicenter of venture capital and there's a lot of activity. But at that point, we had already really found our product market fit and our traction. We already had great customer stories and we were already proving ourselves. So my no to that side of that answer was no, because we're building a sustainable company that delivers meaningful value. It doesn't really matter where I live. I can do that from wherever. And I'm, on the road anyway, so it doesn't really matter where my headquarters are.
So it was the potential customers that were the most tempting lure.
Absolutely. And they've always been. I mean, we've always, and just to kind of play off your thesis, events, right? I mean, there's a ton of startup founder focused events, but I mean, again, not to throw shade at them, but it's just, in my opinion, a lot of splashing water. It's founders meeting founders, and they're really not focusing on building that business where, we've actually acquired the majority of our customers to date from events, but they are events for our customers. We go to independent sponsor conferences, emerging manager conferences, anywhere where there is a concentration of potential customers and current customers. And my quote whenever our sales and marketing team does an event is, be more than just a booth or be more than just a table. I always, or one of my team members always, make sure to have some sort of speaking engagement at the conference, not just us, but with a customer too. Because it's one thing to have somebody from Verivend talking about how great Verivend is, but it is completely different to have a customer talking about the value and the ROI they've got from using a platform like that.
Yes.
You started your story with sticking notes on a wall, but why? Like, why did you even, what drew you to like payments or AR? What inspired you to write the sticky notes?
That's a good question. Um, so my co-founders and I were kind of all at a point where the companies we were at had gotten to a point where it wasn't what we originally signed up for. Not that there's anything wrong with that, but we were kind of feeling that itch again. And we had been through that cycle a couple of different times. And through being at these big companies, we're like, man, these companies just suck at how they run their payments and their AR. And it's insane where you've got I don't care, 20 million, 50 million, 100 million, multi-$100 million company. And it's insane how they're, moving money and managing their finances behind the scenes. So based on kind of where we were in our career journeys and getting that itch of wanting to get back to building again and be operators and not work for a big company, but also what we've seen at bigger companies, we were like, there's something here. Let's start putting those post-it notes on a wall and seeing if we can make something work. Yes.
A couple of questions.
Sure.
Is there any other company that does what Verivend does?
Not in the private markets. We're the only one.
And when you say private markets, are those solely private equity venture capital funds, or also multi-strategy hedge funds, family offices? And if not, is that an area which could be a potential target? And maybe take it a step further, the public markets, RIAs, broker dealers, banks.
All of the above. However, the curse of potential is quite literally a curse. And we saw that when we went, too wide and not deep enough in our early stage. So, and Scott's looking at me right now. He's probably saying, yeah, Rodney, just say yes to everything. Say yes to everything. So we are fortunate enough to have Scott Canales and Bill Sherman here and Bill Krager. I thought he was sitting there. He is. So yes, but we've really tried to be disciplined based on the learnings that we've accumulated over our journey. So to date, mainly focused on private equity, venture capital, real estate as kind of those three core asset classes, starting to focus on private credit. We've got some really interesting things happening there. But yes, to your point, RIAs, hedge funds, family offices, and then going to the public markets because it's really no different. It's so archaic and it's so manual and it's so insanely insecure on how all these transaction. And we're talking about trillions and trillions of dollars a year transactions that we can really help modernize and secure. Yes.
Follow-up question to that, what is the target fund size that you're seeking as a client?
So we support fund managers all the way down to independent sponsors. And I mean, depending on the asset class, you've got independent sponsors in private equity, you've got syndicators in real estate, you've got SPV and syndication managers in venture capital. They're all just different ways to describe the same thing, deal by deal investing. So we support those customers down to, several $1 million, even a couple $100,000 deals, all the way up to firms that are launching, multi-billion-dollar funds or doing several $100 million co-invests, and everything in between.
Yes. Might be a silly question, Rodney.
No silly questions.
How did you
Only
make
silly people?
Yeah.
How did you make money? Like, I formerly worked at a startup called Melio and just got acquired by Zero.
Yeah.
Often found it hard asking for people's money just to accept money. So did you go like a SaaS-based model, transaction fee? How did that work?
Which
Version of our pricing do you want me to start with? Version 1, 2, 3, or like 17? Pricing for an early stage company is really, really hard to get right, especially on day one. So what we did was we went with the most automated and frictionless way to get money from our customers that we thought. And it was to do a percentage of a transaction. So we said, and this was back in the AR AP days. So if somebody, one of our customers who was sending out invoices and wanting to get paid quicker with better transparency and more efficiency, if you want to get paid on Verivend, you send out all your invoices, we take a cut of that transaction. And that cut was 20 basis points up to a max of $20. And that proved that people were willing to use the platform and pay for it, whether they wanted to or not, because we were taking the money as we got their money, right? But while that proved the model and that got us some initial revenue, it wasn't recurring revenue and it wasn't predictable, right? Because it was so volatile. It was based on how many customers we had, how much were they using the platform, were they not using the platform. So as we focused on the private markets, we used that as an opportunity to reframe our pricing, and we went to more of a SaaS model. And the first SaaS model, and don't worry, I won't go through like all 17 iterations of pricing, but we focused on a SaaS model. We did a couple different iterations of that. We said, okay, it's based on the dollar volume that you're going to transact on an annual basis. Then we said, maybe it's based on the number of LPs. Both of those worked to a certain point, but then started breaking. And this was really just through experimentation and listening to our customers. And then we combined it. So now it's based on those two metrics. And that's what we found really helps serve our customers best and get them saying yes the easiest and paying us. Yes.
You may have said this, but were there other opportunities that you considered for acquisition, or was this the first one? Or were there others that, but maybe like you weren't the right fit? Because I know that you were very aligned with the vision of IALTA. And one other thing, what has been like the biggest challenge, if anything, like just in the transition from, you kind of being solely like in charge of everything, and now like, partnering with IALTA as a founder?
How much time? Yeah, I know. Scott has been an angel. He's been great. All right, so in case people over here couldn't hear it, these were two really great questions. Number one was, did I get approached for any other acquisition opportunities, or did we think about that? And then two was, what's been the transition like? What have been some of the challenges? The first, did we get approached or did we consider any acquisitions? We had other firms, other roll-up strategies, other companies come to us and say, we want to roll you up into this payment strategy we have, or similar kind of pseudo competitors say we want to merge with you, but none of those felt right. And one of my previous board members said it really takes 3 times to be acquired, right? And that third one is where you're going to really find that synergy. And fortunately, that's what we found with IALTA. But it honestly was an opportunity that we weren't even looking for. As I said before, it was something that we hadn't considered at that time. Obviously, that was the long range goal, but it was something that approached us earlier. But it just made so much sense because of those, the shared vision, the track record of the IALTA founders and everybody who surrounded themselves, and the connections to Buffalo. So, second part of the question was challenges. I think the biggest challenge is just taking everything that has been in my brain for the past 6+ years and getting it out to other really talented, really skilled people at the company to be able to do it and to continue to do it. Because as a founder, you've got so much in your head, you've got so much on your plate, whether it's scalable or not, or whether it's an awful process, but you just got to do it, you do it. So being able to kind of get that muscle memory out into historical documented information, and also figure out ways that you can scale that and make it more operational efficient. All right, we'll do one more question if there are questions. And if not, we can all just go to happy hour. Let's do it. All right. Thank you, everybody, for listening. I really appreciate it. Thank you, Shelby, for the opportunity. Thank you.